Trader, there's a kind of loss that never feels like a mistake. Your level was right, your direction was right, and price still took your stop and then went exactly where you expected it to go, without you. Your analysis was not wrong. What was missing was fuel. That fuel is liquidity, and once you see it on the chart, your entries and exits change immediately. You stop placing orders where the market has nothing to work with, and you start finding trades where risk is small and the room ahead is large. In this video, I will explain liquidity from a smart money perspective, show you which moves are liquidity grabs and how to mark those areas yourself, and finish with a rule-based strategy to trade them with a defined entry, stop, and target. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. One idea has to be clear first, because everything depends on it. Liquidity is not a signal. It is the condition that has to exist before the move you are waiting for can happen at all. So what is liquidity, in practical terms? Liquidity is money available in the market. Every trade printed on your chart is a transaction between a buyer and a seller. So the more money resting on both sides, the easier it is for a large participant to trade without pushing price against itself. Think about a corporation converting hundreds of millions of dollars into euros. If it does that while liquidity is thin, price runs away while the order fills, and every remaining euro costs more than the last. That is what it wants to avoid, because the whole point is to buy cheap. So it needs liquidity. Or plainly, it needs sellers, enough of them in one place to absorb the size it trades. Which brings us to the real question. Where do those sellers gather? Liquidity forms where retail traders commit. When price reaches this demand zone, traders step in with buying pressure. And not only retail traders, small banks, private funds, and other institutions do the same. If they place their buy orders here, the protective stops sitting underneath are sell orders. That is the part most traders never think through. A stop loss feels like protection, and loss aversion makes us want it defined before anything else. Mechanically, though, it is a resting sell order at a known price, and a cluster of them is the pool a large participant was looking for. So the liquidity zone is not the demand zone itself. It is the area just below it. Once enough orders rest there, the condition is set for that liquidity to be taken. Price dips in, those sells are filled, and the market makes a sharp move to the upside. The same thing happens at the top of the chart. When price reaches this trend line, it acts as support, so traders go long on the touch and place their stops below the line. So this is our liquidity zone. And below it, we have a major level of structure that recently acted as both support and resistance several times. If price travels into that major level, we get an excellent opportunity to go long, because the liquidity collected on the way is the fuel the market needs to continue the trend, exactly the move we want to be part of. So what you gain by marking liquidity zones on your chart? The first gain is qualification. A demand or supply area with liquidity resting in front of it is a far better opportunity than the same area with nothing in front, because liquidity is the fuel for the move. The second gain is separation. You learn to tell a minor liquidity pocket with a low chance of working from a major demand or supply zone that deserves an order. That sharpens your entries and removes a whole group of losing trades. Look at what happened here. Price broke through the structure level with inefficiency and left a clean order block behind. If price comes back into this area to fill the gap, it becomes an excellent place to plan our buy orders. Then, after that sharp move, the trend became exhausted, and notice how many liquidity zones it created while it stalled. Price then broke those support levels, took out the early buyers, collected that liquidity, and continued to the upside. Those early buyers were not wrong about direction. They were positioned in front of the fuel instead of behind it, and being right too early looks the same as being wrong on your statement. So here is the important point. Liquidity being taken before price reaches an order block makes that order block a much better opportunity. But it is not a law. Price can just as easily drive straight through it and turn the move into a major trend change. This is where confirmation bias does its damage. Once you have marked the zone and watched the sweep, the mind treats the entry as justified and stops asking whether the market agreed. That is why we drop to a lower time frame and wait for a reversal pattern before entering. Now, the types of liquidity you will find on a chart, there are many. Trend lines, consolidation ranges, even the major moving averages. But we pay attention mainly to equal highs and equal lows, because this has to stay simple enough to use in real time, instead of becoming one more layer of analysis. So look at this example. This is how we separate major supply and demand levels from ordinary liquidity areas. Starting from the left, we had a strong move to the upside that left inefficiency behind. There, we would wait for price to come back down, fill that gap, and give us our orders in the order block. Here, we had an opposite color candle that created inefficiency, a perfect demand level to trade from. And at the top, a major level of structure that recently acted as both support and resistance several times. Again, a clear opportunity for buyers. Now that the concept is clear, let us turn it into a rule-based strategy, so nothing is left to interpretation while the candle is forming. This setup is not limited to any time frame, and it can be traded in Forex, crypto, and stock markets. It is simple, and it consists of 2 steps. First, we identify the trend, and let me be upfront about the tool. We are going to read direction with the 50 exponential moving average, which is not how smart money concepts are usually taught. I use it here because it gives someone starting out an objective read on trend, with nothing left to interpretation. What we recommend, and what we use ourselves, is market structure. I left a video on the card and in the description that covers exactly that, so you can replace this step as soon as you read structure comfortably. So we apply the 50 EMA, and we need price to break it in one direction and deliver 1, 2, 3 moves, with the third move breaking the structure level. Here, price broke above the 50 EMA, made its 1, 2, and 3 moves, and broke the previous market structure. And notice that even in this version, structure has the last word. The third move only counts if it breaks the structure level. The average points, the structure confirms. So our trend is bullish for as long as we hold above that higher low, and from there, we look for buying opportunities only. In the second step, we wait for a liquidity sweep pattern. We let price build a support, and then it either wicks below that support and grabs the liquidity, or closes below it and gets back above. Here, see how the market built its support, and then collected the liquidity with this long wick candle. From there, you can enter right after that candle, or wait for confirmation with a candle closing higher than the previous one. Our stop goes below the long wick candle, and we target the next level of structure. You can also bring the trade to break even by closing half of the position when price reaches your 1 to 2 target. Watch what that wick does to the trader on the other side. While it prints, it does not look like fuel being collected. It looks like the level failing. He exits into the very order that completes the sweep. That is why the entry comes from the rule, not from how the candle feels. Here is a key point. Always check the higher time frame to see where price is and how much room it has before the next level of structure. This is the same chart moments before the trade. Zooming out to the 1 hour, price recently broke structure to the upside and has plenty of space before the next structure level. And if price breaks that high or low to the downside, we look for shorting opportunities on the lower time frame until it reaches the next level of market structure. And everything we discussed applies to the bearish scenario as well. So let us look at a bearish example on the Euro-Dollar 15-minute chart. The market broke the 50 EMA to the downside with its 1, 2, and 3 moves. So we have a bearish bias. The market then built a resistance and broke above it, grabbed the liquidity, and came straight back into the range. This is also what we call a failed breakout, and it is exactly when we execute our trade. As I said, this strategy is not tied to a single time frame or session, but do your own backtesting to find which pairs it performs best on. So keep the whole video in one line. Liquidity is fuel, not a signal. The sweep only tells you the tank is full. Structure and your confirmation tell you when to turn the key. Mark the pools, let the market take them, and enter when the rule says so, not when the move finally looks safe.
So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.